What we're living through is probably the biggest thing that's happened in financial markets since the breakdown of the Bretton Woods system. Now, as a trader, you'd have learned lots of things about cycles and business cycles and how to play business cycles. Now, most of those things can become entirely inoperative if you live through a big structural change. And that's what we're living through. So I think it's time to be cautious. And it's not time to assume that all the things that you've learned in the last 20 years necessarily hold true anymore. People who still don't believe that, I really suggest they listen to Christine Lagarde's speech in the University of Maryland last week, which makes it pretty clear what the new rules might be in this new world, a world of capital controls and exchange controls. We're not in Kansas anymore. When movements are this large, one has to sort of just step back and say, is this discounting something big that's happening in the real economy, or is it just nothing of great importance? And you have to make that call. Now, I'm making that call and saying, no, this is discounting something really bad that's happening in the real economy. And you do need to do something about it. You don't have the ability to sit back and watch it. And people may say, oh, well, I've already lost 20% of my French or German equities. And, well, 20% isn't very much in the whole scheme of things if something very important is happening. And what is happening is that central banking is failing. And that really has profound implications for the world and how it works. So I'm not normally someone who would come on and tell you, oh, the markets are moving, you need to do something. I'm not really a big fan of activity, I'm a big fan of inactivity. But this is a time to position yourself in a very safe place and then wait. We need to understand it's a bear market in equities, but I think it's a bear market in corporate debt as well. Equity prices are coming down because corporate cash flows are coming down. That also undermines the price of corporate debt. So those are two assets to avoid. If we avoid those two, what is there left to be long of? So cash itself is actually a form of asset, particularly in a world of no inflation. And if we ever had a world of deflation, the value of cash itself is going up, and that includes bank deposits in very safe banks. Government debt is also an asset, particularly if it's in a currency which you think is going to appreciate against your own, as the Swiss franc did for most of the 1970s, and I think that would be the United States dollar. And we can also add in gold. In a world of financial instability and lack of faith in central banking and also financial assets generally, gold should do well. So those are the assets that one can seek to preserve wealth in while you wait for the great opportunity to buy equities. Equities fall pretty dramatically if it's a world of falling cash flows. And they can fall very slowly if it's a world of rising inflation and rising interest rates, and that tends to be a long, slow bear market. But if you look at 1921, 29 to 32, 37, and 2007, 2008, these were all ones that they just collapsed, and they were all associated with deflation. Now, I don't think there's anybody watching this anymore who believes that the world is rife with inflation. So if this is a deflation one, it should happen pretty quickly. But the reason I'm urging caution to traders in particular is that they'll change the rules. This is a game where the rules are about to change. The governments are not going to sit back and watch this. They're not going to say central banking has failed, let's give up. They're going to come back with something else. And that's what you have to remember, that we can all play games, but when the referee joins the opposition, it's time to be particularly cautious.